Good evening to all of you. Welcome to the today's webinar on the topic of innovation and market dynamics driving the 5 trillion capital market evolution. And we are very happy to have Dr. Pradipta Rathi Panda, who is Assistant Professor of IIM Raipur. Just to have a glimpse why we have chosen this topic, we know that with the rapid digitalization of the economy and the increasing penetration of internet and bandwidth, we have witnessed remarkable growth in the financialization of household savings. The surge in demand for demat accounts has further strengthened the economy, reaffirming the fact that capital markets are indeed the backbone of economic growth. The Sensex crossing the 80,000 mark and steadily moving towards the historical milestone of 1 lakh reflects the tremendous momentum built since the COVID-19 lows of around 25,000 in 2020. Such unprecedented growth calls for robust regulation, and SEBI, with its vigilant oversight and slew of reforms, has ensured investor protection and market transparency. Today, we will deep dive in these developments and gain valuable insights from an expert in financial markets. It is a privilege for us to extend a warm welcome to our distinguished speaker for today's webinar. Before we start formally the speech of our chairman and our guest and also a special address by our advisor, we start with our institute's anthem and an auspicious note.
असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय.
Now I request our chairman of BFSI board, CMA Chittaranjan Chattopadhyay sir, to give his welcome address. Over to you, sir.
Thank you, CMA Dibyendu Roy. I welcome our very distinguished speaker today, Dr. Pradipta Rathi Panda, who has been associated with the institute on many counts. I also am having the privilege of presence of our former CGM of Reserve Bank of India, CMA Partha Chaudhary, who is our advisor of this PFSI board, and of course all the attendees. Today, this session on this particular auspicious day of Ananta Chaturdashi, I think it has got a huge connectivity with the theme. The theme has been chosen in a very articulate manner. I congratulate my department, especially the HOD of BFSI, that he has come out with this proposal to me that we want to have a program on innovations and market dynamics driving the 5 trillion capital market evolution. And I think it would be aptly dealt by the very learned personality, Dr. Pradipta Rathi Panda, who is a young personality, the assistant professor of IIM Raipur. Previously, he was in National Institute of Securities Market. And this important topic will be definitely a learning session for all of our attendees. So I welcome all attendees here. We are very happy, definitely, that Dr. Pradipta Rathi Panda, amidst his very busy schedule, has agreed to be here with us. Now, I just want to add some couple of words before we hand over the session to our advisor and also our main speaker. I just want to state that CMS play a very pivotal role in valuation, risk management, ESG reporting, cost analytics, and strategic advisory, which has helped them position themselves as key navigator of the $5 trillion capital market journey. We all know that market dynamics plays a role in expanding retail participation with the rise of millennial and Gen Z investors driven by mobile trading platforms and low-cost access. Global capital flows receive a boost with cross-border investments fueled by liberalized regulatory framework and global integrations. With the advent of financial inclusion in the form of digital platform, as rightly told by our HOD in his opening remarks, enabling broader participation from SMEs and underserved sectors. We also have the volatility and risk hedging with increased adoption of derivatives, ETFs, and structured products to manage risks in uncertain economic environments. Of course, in final policy, and regulatory shifts with advent of government reforms, SEBI initiatives, and global standards has enhanced market trust and competitiveness. In this current scenario, we have seen that there are many key innovations like your fintech integration, digitalizations, and which of course include your blockchain, AI-driven analytics and algorithm trading, redefining efficiency, transparency, and risk management in capital markets. When we will be discussing on the innovations in driving capital markets, we must have to understand that AI is transforming capital markets by enhancing data analysis, personalizations, and operational efficiency. It's now being used for predictive analytics, algorithmic trading, and risk management. And in case of blockchain technology, blockchain provides secure, transparent transaction recording, reducing frauds and settlement times. It's also enabling decentralized finance, which is very aptly told by our many regulators, that DeFi and tokenization is going to be very enabling provisions. Then big data analytics is another area where big data analytics improves risk management and decision making by processing vast amount of market informations. And then comes your cloud computing, which provides scalability, flexibility, and cost efficiency, enabling capital markets firms to handle large data volumes and enhance operations. And when you talk about the market dynamics, then the digital transformation is revolutionizing the capital markets. Regulatory reforms are being implemented to stimulate market growth and ensure stability. Then sustainable finance is another area where there is a growing focus on sustainable finance, with investors increasingly considering ESG factors. And of course, the last word is globalization, which is driving cross-border capital flows and increasing market interconnectedness. So now the key trends we are observing that there is an increased automations, growing importance of data, emerging technologies are like blockchain, DeFi are transforming capital markets, enabling new business models and revenue streams. When we have studied certain case studies, we have found that in Nigeria capital market, it has seen significant growth with market capitalizations nearly tripling since 2023. So this has helped the capital market to grow like anything. And even in Asian capital markets also, they are playing a crucial role in driving economic growth and innovations. This region has been really been encapsulated with significant growth in market capitalizations, with countries like China, Japan, and Korea leading the way. We have our central bank digital currencies, which would emerge as the digital legal tender, reshaping settlement systems, reducing transaction costs, and enhancing liquidity flows in coming days. The BFSIB has finalized the document of a handbook on CBDC, and very soon it will be released. We have the innovations of tokenizations of assets, which has democratized access to real estate, infrastructure, and alternative investments by converting them into tradable digital assets. Now, the buzzword is green and sustainable finance, with the upsurge in ESG-linked bonds, carbon credits, and sustainability indices driving responsible capital allocations. Also, we must have to appreciate the RegTech and compliance tech is the technology-enabled compliance, reducing risks and enhancing investor confidence. BFSI board of the ICMI has launched the Advanced Certificate course on FinTech. It's a 50 hours course. It covers all the important aspects of FinTech, and we request all the participants to join the third batch of FinTech, which is going on. So in conclusion, what I personally feel, the $5 trillion capital market journey is being driven by a combination of innovations and market dynamics. As capital markets continue to evolve, it's essential to stay informed about the latest trends and technologies. By leveraging these innovations and understanding market dynamics, we can now unlock new opportunities and drive growth in the capital market. Today, Dr. Panda will delve in detail. I just wanted to inform you on the various aspects of our understanding on this particular session. I again welcome Dr. Panda, and I'm very much thankful to all the participants here who will be listening to our program. And I request you all to put your questions in the chat box so that our honorable speaker can really reply to your queries. Thank you for your patient hearing for my words. Thank you.
Thank you, Chittaranjan sir, Chairman BFSI Board, for your welcome address. Now I request CMA Parthu Chaudhary, who is advisor of BFSI Board, to give his special address. Over to you, Parthu sir.
Thank you, Dibyendu. Am I audible, Dibyendu?
Yes, audible, sir.
So, namaskar to everybody. Respected CMA Chittaranjan Chattopadhyay, Chairman, BFSI Department, and respected Dr. Panda of IIM Raipur, officials from the BFSI Department, and the participants, of course. It is indeed a matter of great happiness for me to get this opportunity to speak a few words on this very important webinar on a topic which I feel is the most relevant and interesting in today's economy, that is the innovation and market dynamics of the capital market. Now, Chittaranjan sir has very clearly and elaborately set the stage for the discussion to start, highlighting the significance of the capital markets, its involvement in our country and abroad. So I will just highlight a few of the points which is coming into my mind about the capital market evolution and its pivotal financial impact on any economy, including our economy. Ours being a developing economy, and it is looking to integrate with the world, Viksit Bharat target 2047. So how it is that this capital market development, evolvement is going to be a key factor in our development of the economy. Now, if we look back, we can always see that post-liberalization of our economy, capital market gained a lot of significance. Of course, the regulatory framework has become much more robust over the years, and the infrastructure to support a transparent, efficient, transaction-driven market has gone a long way. Now, as we are always aware of that, a few of the very important aspects of a deep, robust, and transparent capital market is price discovery, provision of liquidity, and of course, mobilization of resources which are often scarce, keeping a sharp eye on the risk management. Now, we are also very much aware that the regulator in this segment of the market is SEBI, and there are exhaustive set of laws in place which regulate this market, such as Companies Act, Depositories Act, Prevention of Insider Trading, Takeover Code, all these laws and rules. I just want to flag that in spite of this progress, in spite of the robust regulatory framework and a strict vigilance by the regulator, there are challenges, which is mainly coming from irrational volatility and investor sentiment. Of course, financial literacy goes a long way in making the market behave rationally. In our country, a lot of investors are not fully aware of the instruments, the products, the trades which they undertake. And with derivatives and other structured products coming into the market, it is indeed a concern for the regulator how to educate the investors. Today, we are very happy to have with us Dr. Panda, who has immense knowledge and experience in the capital market related issues. So under this backdrop of regulated capital market, evolving capital market, getting deeper and deeper every day, participated by financially literate and also not so literate investors, it will be a very interesting topic to listen to Dr. Panda. I'm sure of that. My only humble request to Dr. Panda is that at any part of your deliberations and your presentation, please also highlight the role of CMAs in the capital market related functions as advisors, consultants, and also as a participant. I'm very sure that all the participants of this webinar will be immensely benefited from the deliberations. And I sincerely thank BFSI board for arranging such a important webinar on such a auspicious day. Thank you very much for your time. Jai Hind. Back to Dibben.
Thank you, Parthu sir, for your wonderful special address. Before we hand over to Dr. Pradipta Panda, just a short profile. Sir is presently the faculty of IIM Raipur, and previous to that, sir was working in NISM, where we had a chance to meet, and also sir had taken many classes in our investment management courses. Sir is presently assistant professor and holds a PhD in financial markets from University of Mumbai. Apart from that, sir is associated with a lot of other activities. He has done masters in finance and control, MPhil in financial markets, and his PhD topic was stock market spillovers, evidence from BRIC countries. He also received the Best Doctoral Thesis Award at the IIF International Conference and Award Summit 2021, organized by the Indian Institute of Finance. Sir is also working in the IIM Raipur. He was previously with NISM since 2015. He was in NISM engaged in teaching, training, and research in financial markets. Dr. Panda's research interest also encompasses market microstructure, mutual funds, international capital markets, derivatives, and innovative financial instruments. His teaching portfolio includes financial institution and markets, market microstructure, trading and investment in equity and equity derivatives, corporate finance, behavioral finance, applied financial econometrics, financial computing using R and Python, and financial derivatives, among others. He was also a lead member for developing and successfully implementing the NISM Trading and Simulation Lab in Indian securities market. Dr. Panda has presented his research at various international and national conferences and organized several faculty development programs. Notably, he initiated the Capital Markets Conference at NISM in collaboration with London School of Economics. He also successfully coordinated 4 CMC and 4 SEBI NISM conferences during his tenure at NISM. With this profile, I welcome Dr. Panda, and the stage is yours, sir.
Thank you very much, sir. Good evening to all respected CMA Chittaranjan sir and respected CMA Partha sir and CMA Dibendu sir and all the officials and also all the participants. Good evening to all of you. So the topic is on the innovations and market dynamics driving the 5 trillion capital market evolution. So I thank CMA, especially Divendra Ray sir and Chittaranjan sir for the opportunity, and all of the participants for the opportunity to interact with you. We were interacting regularly when I was at NISM. We used to conduct some collaborative programs on trading and investment for CMA members. So with this, let me just briefly tell what are the plans or the agenda of this discussion. So we'll first understand the market activities. Then briefly we'll touch upon exchanges, which are the stock exchanges, commodity exchanges, international exchanges, social stock exchanges. Then we'll see key activities in primary and secondary markets, and key activities on derivatives markets. Then Chittaranjan sir has rightly said, like, there are lots of development on the sustainable finance front, and we'll touch upon some of the regulatory reforms and some of the innovative products that are coming in and that has been allowed in our market. So on the sustainable finance front, then what are the regulatory innovations, and I'll touch upon like some of the aspects of what are the role of CMA in securities markets. Although I am not a CMA, but I am closely associated with the CMA Institute, and thanks to Chittaranjan sir for the opportunity. Since 4-5 years I am associated with. So with this, let me just start. So there is a small disclaimer. Whatever I'm presenting is not from my institute's point of view. It's like my personal viewpoint. And let us simply see some of the facts and figures. Divendra Ray sir also mentioned some of the figures. Whether does it matter to me either as a member of the Costing Institute or as an individual or as a professional? So some of the facts I'll just place in front of you, then we'll move for our discussions. First is Sensex is reached 86,000 plus and Nifty is 26,000 plus. And there are certain aspects like during 2008 financial crisis, 65% market crash was there and 37% correction was there in COVID-19. So I'm using two words. One is market crash and another is market correction. Whenever market falls down by 50% or more, we call it as crash, and if it is less than 50%, we call it as correction. And there are so many geopolitical risks that are coming in the current days, and so many threats from other countries as well. What will happen to market? There are so many debates that are coming in. So again, in the primary market, basically during IPOs, all of the subscribers are subscribing for getting listing gains, and they are just 50% are selling within a week of the listing, and 70% are selling the value they are selling within a year. So that is SEBI report is giving us. So then social stock exchange got good amount of acceptability in India, which has introduced an innovative instrument called as zero coupon, zero principal bond, and it leads to impact investing. We'll also understand how far we have reached on this social stock exchange. Then international stock exchange in the GIFT City has been set up, and that is open for 22 hours. What is happening in those international stock exchange? There are all asset classes like commodity, currency, interest rate markets. We are growing, although in some asset classes like commodity, we are not in global picture, but in terms of currency and equity, we are number one. And we bring out different colors to the instruments. Although we know like there is green and red colors in the market, but there are so many colors that are there in terms of instruments. Like Chittaranjan sir was mentioning green bond, there are blue bond and yellow bond, and there are so many other categories of colors in the instruments that we attached. And number of demat accounts also reached 22 crore plus, then 89% in 2022 and 93% in 2024. Individual traders made losses in derivatives, and option is the most beautiful instruments in the securities markets. That's how all of new entrants or all the participants, they want to earn more through this option, and they are leading into huge losses. And even in equity case, 70% are losing. And there are so many things, whether this matters to us or not, but we need to understand the figures. How does it enhance my personal finance? How does it enhance my professional activities? And how does it enhance my country's economy? So I'm just placing some of the facts that is published in Market Pulse. It is published by NSE every month. So you see, first part, if we look into these categories of gross turnover and gross turnover and shares in financial year 2024, you see the categories of investors, either corporates, FIIs, BIIs, individuals or proprietor traders or others like trusts. So if you see in terms of CM, which is cash market, highest percentage of individual traders are participating in the cash market transactions. And similar things happens on the equity options. The second highest are individual traders, and the first highest is proprietary traders. And on equity futures, although third highest, this individual traders, but FIIs and proprietary traders are participating at a larger extent. If we look into the below three plots, one is FIIs activities, DII activities, and individual investors activities. Now FIIs are no more creating volatility on our market because DIIs are supporting. So FIIs are foreign institutional investors, DIIs are domestic institutional investors, our mutual funds, pension funds, insurance companies, banks, financial institutions. So they are coming under DIIs. Whenever you see FII starts selling, DIIs have started buying at a larger extent, so that they are giving a good support to our market. So this was not their pre-COVID scenario. Pre-COVID scenario, this was completely opposite. Like whenever FIIs were selling or they want to create volatility on our market, they can create, but now they are not. And if you see post-COVID, the surge of individual investors were huge on our market. That's how we or our market, whatever contribution is coming to DIIs, it is the individual's contribution. If you see, mutual fund is participating, who are contributing to mutual fund, the individual investors. A pension fund is contributing, insurance companies are contributing. So those are the contribution of individual investors. So indirectly, individual investors are giving some support to Indian securities market. Now, the previous one was 2024 activity, and this one is 2025 activity. And similar activity you can see on the cash market and on the instruments. I just missed one thing to tell over here. If you see, out of 4 derivative instruments, index option is the most attractive instrument, which attracts like more value gets traded or more contracts gets traded, and that is same for the period of 2025 as well. For the period of 2025 as well. And see the activities from 2015 to till date 2025, the DII, FII individuals, and in rupees crore and in US billion dollar. You see, whenever DIIs like FIIs are selling, DIIs are buying more than that, whatever they are selling. Here you see FIIs has sold, DIIs has bought back. Now that is one. then the second one is we have crossed $5 trillion our Indian capital markets market capitalization. If we simply say how much we contribute to the world market capitalization, that means what are our contribution in terms of world market capitalization. If we look into the number of listed companies, we are number one across the world. There are 48,000 to 50,000 listed companies are there across world. That too from India, 5,600 plus companies are listed. So we are contributing 13% to world market, world listed companies. But in terms of number of percentage to market capitalization, although we have reached $5 trillion, but we are contributing 4% to world market capitalization. And USA always contributes the highest, and Canada 3%, even Japan and China are contributing at a larger extent. So China is contributing almost for 13-14% to world market capitalization. But in terms of percentage of listed companies, we are number one. Now, if you compare to USA or Canada or Australia, so India is number one. You compare to any of the countries' number of listed companies. Now the head is the mutual fund AUM. How much mutual fund are managing asset under management? That was 20 lakh crore. It is 20 trillion rupees in 2017, and it has gone to 30 lakh crore in 2020, and 2023 it was almost 50 lakh crore. And today it is like 72 lakh crore, almost 75 lakh crore on the latest data. That means the mutual fund industry has grown at a faster rate, and it requires a huge amount of professionals to actively manage this huge funds. One is in fund management, one is mutual fund, another is AIF, which is alternate investment funds, and third one is our PMS, which is portfolio management services. So all the three have gone up like anything. They are attracting good amount of investments or fund mobilization, and they are investing in the market. Now, if we keep on investing in the market, there are two products in front of us. One is passive and another is active. So passive fund and active funds are there. In the active fund, we take relatively higher risk as compared to passive fund. So in passive fund, we say risk is very limited or almost zero. Whenever we consider a index fund or ETF, we keep on investing and we get some amount of return. But in an active fund, we may get higher return or we may get lower return. What has happened to our passive fund or what has happened to our index funds in our market vis-a-vis other countries' markets? You see, these are all CAGR, compound annual growth rate. So this compound annual growth rate for India, USA, Japan, South Korea, and Indonesia are in front of you for over 5 years, 10 years, 15, 20, and 25 years. If we look into Indian market, we are getting 10.8%, almost 11% compound annual growth rate in 5 years. None of the other markets are able to give that much. Although USA is giving almost 9%, but it is lower than Indian market. And if you see on a longer term, longer horizon, if we go for 20 years, Indonesia is providing closely to the India, but we have to stay invested for 20 years in Indonesian market. But so that's how we get a huge amount of funds flow from the foreign institutional investors as well as domestic institutional investors. Now, all of you are aware what are securities. So these are defined by the SCRA, which is Securities Contract Regulation Act. So that includes shares, bonds, debentures, or units of mutual funds, units of CIS, derivatives, and derivative is a long definition on SCRA Act. And these are all mostly insecure instruments. That's how SEBI is there to give security to these instruments. So all of you are ever like this banyan tree is the mother of our Indian securities market, and under this tree cotton trade was happening before 1875. We are doing cotton trade to the European countries, and there was huge demand for Indian cottons because Indian cottons were having good quality and there was shortage of cotton in European countries. That's how the demand was more, and these cotton traders started betting with different prices. That's how the birth of Indian securities market started under this banyan tree. This banyan tree is still alive in the port area in Mumbai. What are the exchanges that are currently there? There were so many stock exchanges, so we have closed down all the regional stock exchanges, and currently we have only 3 stock exchanges. Quickly, we'll see that. So Bombay Stock Exchange, which is the Asia's oldest stock exchange, established in 1875. Then SEBI came into picture from 1998 and 1988 and got statutory power from 92. And NSE, the first electronic stock exchange, came in the year 92-93 and started operation from 94 onwards. So 2008 Metropolitan Stock Exchange came into picture, and that is, although volumes were less, but still that is one of the national stock exchange. So BSE, NSE and XMSE, these 3 stock exchanges are there. Now in 2016, we established 2 international stock exchanges, all at GIFT City, which is International Financial Service Center. So one is India INX and the other one is NSE International Stock Exchange. India INX was established by BSE and NSE International Stock Exchange was established by NSE. There are so many listings that has happened on these 2 exchanges, although equity listing is yet to commence, but bond listing and derivatives trading, currency trading that are happening for 22 hours. And we moved one of the very liquid instruments from Singapore Stock Exchange to GIFT City, which is called as GIFT Nifty. So earlier it was called as Singapore Nifty or SGX Nifty. That has been moved from Singapore to India. That means if you see in the evening, those who are observing news, you see GIFT Nifty has gone up or came down. You will see the like 22 hours activity on GIFT Nifty. And on next day, what will happen to our market also is one indication from the GIFT Nifty. Now in 2012, we established SME. So BSE SME and NSE SME, 2 platforms, 2 existing stock exchanges established, and they are doing very good in terms of attracting the SME companies to come in and get listed and raise funds. And there are certain instances like when SME companies fulfill the main board criteria, they are allowed to migrate from SME platform to main board platform. So these 2 platforms are different in terms of stringent norms in the main board platform and relaxed norms in the SME platform, because SME companies may not fulfill all the criteria that is required for a listing in the main board. And we are getting success in that. So social stock exchange, all of you have heard about social auditors, like SEBI has allowed all the CMA and CA to act as a social auditor. So this social stock exchange actually is given that opportunity of being become a social auditor. What is the role of a social auditor? The social auditor will audit the social activities of a social enterprise. How to like define a social enterprise? There are certain terms of social enterprise. So these social enterprise are of 2 categories. One is NPO, another is FP. So not for profit organization or for profit enterprises. Now to get listed, they require minimum like minimal annual reporting requirements, and for profit organization they don't need to require for any of the things. So then the instruments which are there for a social enterprise to raise fund is called as zero coupon, zero principal instruments for the not-for-profit organization. And for-profit organization, you can go for SME or IGP, which is called as Innovator Growth Platform, although that has been created to attract more tech companies to come in or raise funds. So far, none of the companies have opted this IGP platform, but SME is accepted by many companies, and almost 700 plus companies are listed on SME so far. Or debt securities they can issue. We heard about this zero coupon bond on our curriculum. We read, and it is sold at a discount. But what is the benefit of a zero coupon and zero principal? In zero coupon, since I bought it if it is simply a zero coupon bond, I bought at a discount and I get back on maturity the whatever face value is, so that I can earn some yield out of getting a discounted bond. But when it comes into zero coupon and zero principal, I will not get back any coupon, or I will also not get back any principals. So why I invest in those instruments or those organizations? So it is called as impact investing. So I will invest for the social impact, or I will invest for the betterment of a society. Instead of donating to someone who I know, like I don't know, and whether that fund will get utilized properly or not, if I donate that same thing, or I purchase that instrument which is traded on the exchange will take care about the whatever activities that organization is doing, because they have to disclose continuously. So that's how it comes into zero coupon, zero principal fund. And there are many enterprises, they have to first register to get certified as a social enterprise. Thereafter, they will be allowed to raise fund and get listed on the secondary market. That is the whole process. Now, if we see, there are so many, there are NSE has a platform and BSE has a platform on social stock exchange. Now, in terms of commodity exchange, although now commodity is part of SEBI, now that's how NSE, BSE, and all the stock exchanges have started their own commodity platform. So MCX is known for metal, which was established in 2003, and NCDX is for non-agri commodities, which is agri commodities. MCX is for non-agri commodities. NCDX, National Commodity and Derivative Exchange, is for agri commodities. So they both were established in 2003. And in 2008, ICEX, which is called as Indian Commodity Exchange, came into picture. So there were other regional commodity exchanges also, along with regional stock exchanges, which has been closed down. Now let us come to our discussion on primary market. So in terms of primary market, there are primary market provides the opportunity for a company to raise funds through different primary market instruments. So the issuer will issue that instrument and the investor will invest. There are intermediaries, they are part of the system, so they help in all the book building process or bringing out the IPO applications. So there are internal audits, external audit for before filing the applications for IPO, or if it is second time, then it is FPO, follow-on public offers. Let us see what are the instruments in general are available. And one is spot market, another is derivatives market. We say derivatives is derived from the underlying asset which is there on the spot market. So you can see all these are spot market instrument is equity, which is which has two different aspects. One is primary market and another is secondary market. So on the primary market, IPO and FPO are coming. On the secondary market, it gets listed on the secondary market and gets traded onto day-to-day activities. And that's how we get appreciation or depreciation of the share prices. And as and when we want to come out from that market, we can, because market is very liquid. Although some of the penny stocks or some of the companies which are into very riskier part are not getting traded much, those companies are very less, and we should avoid to participate on those companies which are illiquid. In general, Indian securities market is very liquid. Then in terms of debt, again, we can go for corporate debt or government debt. In a government debt, again, government securities or government bonds are there, and T-bills are there. On corporate debt, even in municipal bonds, state development funds, SDFs, those are there. And in corporate bond, we are also growing, although this bond market across the world is specifically across Asian countries are not that developed as equity markets, but over the years, debt market activities are growing. On the money market instruments, these are all short-term instruments. You say treasury bills, or you go for commercial paper, certificate of deposits, or overnight instruments. On the foreign exchange market, again, it has a spot market as well as derivative market. So in the spot market, anywhere we go, we exchange, but the derivative market provides good amount of hedging opportunities, as well as some amount of speculation is happening. In this foreign exchange market, we have two categories. One is the INR versus all the four major currencies instruments are available, and there are cross currency instruments are available. Suppose USD INR, Euro INR, JPY INR, and Pound INR. These are four currencies are traded on the currency derivative market. Along with that, cross currency like Euro USD, Euro JPB. So cross currency instruments are also traded on our market. In terms of commodity, we divide them into agri and non-agri. On the again non-agri, metal, precious metals, base metals, then energy, and non-agri also we have category. So commodity derivative is also growing. Although on agri commodity we are not able to grow that much, but in terms of energy and metals we are growing. And in terms of financial derivatives, equity derivatives, equity options, futures, swaps that are coming into picture. Although swap is a OTC product, but futures and options are exchange traded product. So this is brief about the financial instruments that are there on our market. Now, as a company, what are the opportunity to raise fund from the market? So there are three options for a company to raise funds, either from India or from outside India. So if as a company I want to raise some fund, I can go to banks or financial institutions to get some funds, and they have some limitations. After that, they will ask us to go to raise funds from the market. If it is debt, then I'll go and issue debt securities, or which is called as bond, from the market and raise fund. And each bond will have one expiry date. I have to provide whether it is coupon bearing or not. If it is not coupon bearing, then I have to sell it at a discount rate. If it is coupon bearing, how much coupon I will pay and period of coupon, and everything I have to mention as a company. Now, if I want to raise fund from outside India, whenever basically I have a subsidiary in USA, I need USD, and I don't want to take that exchange rate risk, and I can raise fund in terms of USD from USA market. So I can issue ECB. So this is called as external commercial borrowings. Now, in terms of equities, I have an option of IPO. I'll go and raise funds through IPO. Initial public offers, I have to satisfy ICDR regulation, issuer compliance and disclosure regulations. Then if second time I want to raise, I can go for FPO. Although there are other ways to raise funds like preferential issue or right issue, or I'll go for private placement. So all those issues are there. Then if I want to raise funds from outside India, I'll go for issuing ADR or GDRs. So ADR are American Depository Receipts and GDR are Global Depository Receipts. If I want to raise funds from the USA in terms of USD, I raise through issuing ADR. If you see all the IT companies, be it Infosys, Wipro, they have TCS, they have been listed on USA exchange. It is called as their own ADRs, American Depository Receipts, because they raise fund from USD. But in case of GDRs, like a company which is issuing to other than American countries are called as Global Depository Receipts. But this GDR is not a very popular product for Indian companies. They have not used GDR since 2012 or 2011. So, but ADR is widely used. Now, if I go for various hybrid securities, which is combination of equity and debt, we'll go for various convertibles like either fully convertible or partially convertible bonds, which are coming under hybrid securities in India. And if we go for raising fund through issuing convertible bonds to the foreign countries, we'll consider FCCB, foreign currency convertible bond, or FCEB, which is called as foreign currency exchangeable bond. So that both are convertible bonds only. So both are hybrid securities only. But this foreign currency exchangeable bond is a bond which can be used to exchange from one group of companies to one company to another company in a same group. Suppose TCS to Tata Steel, or you go for Indian Hotels, which is again Tata Group. So you can exchange that bond to other companies if you have as an investor you invested, or as a issuer you issued, you should give that option. Now, how much we raised fund? So see main board IPOs and FPO issues in terms of growth. If you look into some of the say countries, their total number of listed companies are hardly 10, 15 or 20. But if you go for Indian companies, every year we are like 100 plus companies are raising fund from our market. In some years 70, 78, 68, 100, 120, 200, 180. So they are raising funds from our market, and none of these funds or none of these issues whose our company are bringing out the issues are undersubscribed. Like it is highly oversubscribed. In many cases, it goes oversubscribed by 20 times or 50 times, 100 times, or 2-3 times it goes to oversubscription. And in terms of SME issues, also SME companies are issuing almost again you see in 17, 18 highest number of SME companies are issued. Almost 700 of SME companies have issued issued or raised fund from the primary market in India. So that's how, if you see the number of issues on right issue and FPOs, and the other side IPOs, most of the companies are opting for IPOs. But if we see the trends on different issues in terms of IPOs main board, IPOs SME, FPOs and right issue, you see the number of SME IPOs have gone up like anything. In 2023-24, 196 companies, SME companies has raised fund. If you see 76 companies in main board have raised fund, and in terms of FPOs, it is least obtained 1 or 2 companies per year, and right issue 67 or 73 companies have issued. Now, see number of issues, the same thing what we see. You see in terms of IPOs, FPOs, and right issue put together in one side, and preferential issue in other side. So if we observe, most of the companies are opting for preferential allotments or preferential issues, and less companies are opting for IPO, FPO right issues. The possible reason is in terms of IPO, FPO, and right issues, we need to wait for a long period of time. The cost of raising funds is higher as compared to preferential allotment, and the risk of subscription is also there in terms of IPO, FPO, and right issue. But in terms of preferential allotment, since it is allotted to a certain set of investors, so and the process is very fast, the cost of raising capital through preferential allotment is very less. So that's how companies are opting for preferential allotment. And in terms of preferential allotment, how much amount has been raised? If you see the amount, the number of companies they are opting are high, but the amount is not that high in this recent years. In some year it is higher, and in other years it is lower than the IPO, FPO, and right issue. Now, if we put together all the instruments, how much debt, how much fund we mobilized over the years, and how many, like how much amount and number of issues. See, almost 2,500 plus companies are raising funds through different instruments, primary market instruments, and they are raising almost 10 lakh crore plus have been raised over the years and every year. And that's the whole issue, like in terms of debt, in terms of equity, public issue, and preferential and QIP. And in terms of REITs and InvITs, so these REITs and InvITs are introduced from 1718. So it is called as Real Estate Investment Trust, and InvITs. So REITs and InvITs allow us to invest. They are like a fund management. They act like a fund manager, just like a AIF or mutual funds. So in terms of real estate or in terms of infrastructure investment, if I go, it requires huge investment. But if we divide into small buckets, and one bucket or one ticket or one unit is sold at, say, 1 lakh rupees, 2 lakh rupees, or 50,000 rupees, then I can become an investor of a very big shopping mall through buying REITs, or very big infrastructure project by buying or investing through InvITs. And when it got introduced in 1718, there were so much debate like how India will accept. It is well accepted, and 23-24 there were 17 issues on REITs and InvITs. Now let us move to secondary market. So you can stop me in between if you have a question, or you can also ask at the end, or whatever you prefer, you can do that. So in terms of secondary market, if you see, first company raise fund and get it listed on the secondary market, because there will be buy and sell, or because there will be market liquidity, price discovery that will happen if it gets traded. Now, in between, securities brokers are there. So investor will invest in, and one buyer, if one buyer and seller, they will buy and sell through the security brokers or broker firms. There are categories of financial instruments that we have discussed that will get traded. Now, this market design depends how we set our rules and regulations to function, or how we set our market structure. So basically, there are two categories of market structure across the world. One is code-driven market, another is order-driven market. I'll come to that, what are the code-driven and order-driven market. And the third one is the hybrid market, which is combination of quote driven and order driven. Just think about the order driven market like our normal BSE and SME, BSE and NSE, not the SME part. You just think about BSE and NSE main board platforms. So those are order driven because buy and sell order determines the price. And whenever buy and sell price gets matched, trade happens. So that is what order driven market is. And the role of broker is not there, only to facilitate the trade process. Broker is there or to provide the platform or act as an intermediary in between buyer and seller. However, if we go for a quote driven market, which is similar to a brokered market, broker or the dealer in the quote driven market, we call them as dealer and broker driven market broker. They will be responsible for creating liquidity in the market. How do they do? If it is a illiquid market, so they will buy at a higher price and sell at a lower price. So normally we buy at a lower price and sell at a higher price, but the dealer or a broker who in a broker driven market or quote driven market, they create artificial liquidity in the market. And if we see, there is a hybrid market which is combination of this order driven and quote driven market or broker driven market. So some part will be order driven and some part will be quote driven or broker driven. Now best example for order driven market is our BSE SME, BSE and NSE, BSE and NSE main board market or the normal market. And the hybrid market is the example of our SME market, where there are market makers to create liquidity, artificially create liquidity in the SME exchange. And our ETF or the exchange traded fund market also works like a broker driven or quote driven market, because they are also market makers are there to create artificial liquidity. Now Nasdaq and Forex markets are best example of quote driven market. In the quote driven market, your price, you say transparency in price discovery will not be there, because there will be no single price. So each of the traders, they can decide a price and trade it, and they will report it. So that's how it is less transparent, quote driven markets. And dealer provides two-way bid and ask, and they set the prices, and buyers and seller will deal with dealer. Now execution will happen at a dealer price, which is guaranteed. If you want to buy, you will get it. And it is more liquid because dealers are supposed to provide liquidity during market hours, but price discovery is less efficient. Now in case of order driven market, only buyers and sellers, they act with or deal with each other, and the quotes of various buyers and sellers are visible to everybody, and it is there in the order book. Order book is visible to everybody, and execution depends on price arrangements. If the price gets matched, then only trade will happen or trade will get executed. It is less liquid or high liquid depending on the different scripts and trading it interest of participants, and price discovery is very efficient and it is very transparent. And the hybrid markets are like NYSE and NSE SME and BSE SME segment. Now in terms of trading, many times we heard like SEBI has been reduced the trading cycle to T+1, then further T+0, and further it was also thinking T+1 hour. What happens if I start buying now and I am getting the shares tomorrow? What is happening from today to tomorrow? We are currently following T+1, and who are the parties they are getting involved in this process. If I see the buying investors will approach to buying broker, or nowadays no one, like very less are approaching to buying broker. Broker has given us one login password and we can use broker's app and buy or sell. Whenever we bought or sold, that will go to broker's trading terminal, which is there in the broker's registered office or head office. And broker's trading terminal will check whether this is a valid order. If valid order is there, whether if it is a buy order, sufficient price is there. If 1 paisa is less is there, then it will get rejected from the broker's trading terminal. So some basic checkup broker's trading terminal does. Again, there are some advanced checkup or advanced checking that broker's trading terminal does. If one has been divided from the market to participate in this market, penalized and divided from the market for 3 years, 5 years, 10 years, and he's also punching the orders, the system will immediately catch and cancel that order. If you are a politically exposed person, there is no harm of participating in the market. But during opening of the account, we have to declare that we are politically exposed person. Even our family member whosoever are participating in the market, they have to also disclose if you are politically exposed person. If that is not disclosed, or we are part of that family or we are part of that political party, then it will also cancel here. So only thing is politically exposed person will be red flagged in a different category, so that maybe more sensitivity will come from those investors or so. If everything we qualify, then that order goes to exchange trading terminal. Whether we have bought from NSE or BSE, it will go to the exchange trading system, NSE exchange trading system or BSE or XMSE exchange trading system. Now from exchange trading system will again do the second time checkup or second time cross verification, whether this is a valid order or not. Basic checkups as well as advanced checkup of whether that individual has been divided from the market or politically exposed person or so. If that is satisfied, then we get one order validation and confirmation with a order number and all order details, the company name, quantity, timestamp, everything. And immediately the broker's trading terminal will send to the investor, like your order gets validated. And this process does not take much time. This process takes a fraction of seconds to get back to us. Okay, so that much strong our infrastructure or market infrastructure is. Now order gets confirmed does not mean trade will get confirmed. So trade will happen when order gets matched with the other order. Like if buy order gets matched with the sell order, or sell order will get matched with buy order. So the first priority is price. If price gets matched, then only it will get traded. If same price, suppose say I want to buy at 100 rupees, there are 3 sellers, they are standing to sell me at 100 rupees. Then whose order will get executed? The order that came first will get executed, the others will remain on the queue. So that's how it is called as price time priority. Trade happens based on price time priority. And we get, once that trade happens, we get one trade confirmation and it comes to us like your trade has been done with trade time and average trade price and everything. Now, if that is over, then the activities of T0, which is trade day, is over. At the end of the day, exchange will send all the trade details to clearing corporations. So we have two clearing corporations, BSE Clearing Corporation and NSE Clearing Corporation. BSE Clearing Corporation name is India Clearing Corporation, ICC. So Clearing Corporation will receive, and we get as an investor, we get something called contract note. That contract note is a legal note which will carry all the trade details that we did on that day. Along with that, what are the transaction cost or what are the charges that we paid with bifurcation of charges like exchange charges, clearing corporation charges, depository charges, SEBI charges, brokerage charges, all charges with stamp duty and tax, GST, STT, everything will be mentioned on that contract note. And when physical share trading was there, that contract note was more usable, because in any case, if one party gets defaulted, then you can file a case against the other party. Now, since the system takes care about all these issues, and there are rarely defaulter or counterparty risk is coming, so we get that contract note. On the next day, T+1, clearing and settlement starts, and that clearing and settlement happens with a clearing corporation. The clearing corporation will send to clearing member. There are three members. One is trading member, who are broker and member of a exchange, of a stock exchange. The second one is clearing member, who are member of clearing corporation, and the third one is depository participant, who are participant of a or member of a depository. Okay, member of a depository. So these are the participants. They are participating in this clearing and trading process or clearing and settlement process. So the clearing member and depository participant will receive the details from the clearing corporation to cross verify or download the obligations. First one is to cross verify the obligations or satisfy the obligations. Then once they satisfy that, they will inform to clearing corporation. Then settlement of funds or securities happens, or which is called as payout. So pay-in happens of identifying obligations, and payout happens with the settlement. Actual transfer of shares or actual transfer of funds happens in this process, and that's how T+1 will over, and we will get back all our money if we sold, or if we bought, we will get back all our securities. So now SEBI has thought, instead of T+1, let us move to T+0. That's how the evolution. When physical share trading was there, we were following T+70, T+75, T+35, T+15. But from 2000 onwards, we started following T+5 rolling settlement process. So this process from this to final settlement, either buy or sell to final settlement, was taking 75 days, 70 days minimum when physical share trading was there. And it again 35 days, 15 days was taking. From 2000 onwards, it becomes T+5. Now in 2002, we moved to T+3. Within 1 year, we moved to T+2. Now from 2003 to 2023, almost 20 years, we were following T+2. Although we started implementing in a phased manner for T+1, initially for 50 companies, 100 companies, 500 companies, 1000 companies, but the full implementation has happened from January 27, 2003. So we moved completely to T+1. Now we are following T+1. Now SEBI started on trial basis to T+0. You buy that the day, you will get back the funds or securities on the same day, because you will have more liquidity, and it may enhance the liquidity because you will have more funds on your hand. So this T+0 was optional, and that too again some specific scripts it was allowed. and there are only 2 trades that has happened with the T+0. 2 trades mean 2 quantity only. So T+0 is not very much getting accepted by the traders or by the companies, but still we are also thinking to move instead of T+0, which will get settled at the end of the day. Let us move to T+1 hour. That means we buy or sell at 10 o'clock, it will get settled at 11 o'clock. The challenge over here is cost of implementing the regulation, okay, or which is called as implementation cost. If we see the cost benefit analysis, which you people are always doing, so whenever we bring a new regulation, it requires huge infrastructure to implement that. If we see the process that we are following T+2 or T+1, we need to double the infrastructure, our IT infrastructure as well as manpower to run that or to fulfill that criteria or to implement that new regulation. And T+1 hour, none of the countries have moved. Even T+0 also, none of the countries has moved to T+0. Although T+1, some countries have moved, that are very few. India is among the top country which has moved to T+1. Still, USA is following T+2. Now, if we see the market timings, there are many times also this discussion was happening, and SEBI wanted to extend this market timings to till midnight or till commodity market opens or so. But there were again huge strike on that. Then that's how SEBI was not able to move to or extend the market timings. Now, currently we are following 4 markets, or we are following 4 sessions in a market. We call it as sessions. So one is 9 to 9:15, which is pre-open session, where price discovery happens. Recently, SEBI has implemented the price discovery or pre-open session for derivative products, which was not there, which was there with cash market products. And the continuous market hours from 9:15 to 3:30. Then closing session from 3:30 to 3:40, and post closing session from 3:40 to 4 o'clock. So we get one closing price which is not equals to the LTP, last traded price of the script. So the closing price is the value weighted average price of last 30 minutes trade. That means 3 to 3:30. 3:30, last 30 minutes trade is considered as. So again, weights are given to the price which more trade has happened will get higher weights. So that's how it is like the closing price gets calculated in this last 10 minutes, which is called as closing session. And market again opened up at 3:40, which is called as post closing session. So every market has that pre-open and post closing session, but in our market, this post closing session is very inactive. Although market will be open and there will be a single price, which is freezed price with a closing price only. Market moments will not be there, but still you can participate in the market. Even if any open positions are there, you want to close that, you can contact your broker and close it. So that is that facility is there. Now, if we see the trends in equity cash segment, even we are in terms of activities or number of trades, we are again number 1 and number 2 across the years in terms of equity cash segment activities. You see the number of companies permitted or listed and number of companies traded. So half of the companies are almost getting traded and half of the companies are not traded. And here almost less than 1,000 companies are less from the number of companies listed and number of companies traded. Number of trading days depends on how many official holidays are there, and Saturday, Sunday markets are off. And the average trade size if you see, is 19,714 or 20,000 or 24,000 average trade size is. Then you see demat turnover or market capitalization across over the years, and the turnover in terms of rupees crore, it is getting increased like anything. And so this was BSE and this is NSE. So just please read this as NSE. So this is NSE activities. If you see in NSE, almost 2,400 companies, 2,100 companies or 1,680 companies that were listed. So currently 2,600 companies are listed, and the number of companies traded are 2,600, 2,985. So there were number of trading days, although is the same, and average turnover, if we compare to BSE average daily turnover and NSE's average turnover is very high, and average turnover size, if you see, 29,000 in NSE and 19,000 in BSE. Now let us see some of the mode of trading in equity segments. There are developments of infrastructure, development in terms of technology. So we are very familiar with algo and non-algo trades. Then there is a direct market access where broker will not come into picture. Directly your trade will go to, if you think about that trading, clearing, settlement process, so instead of broker, directly it will go to market or exchange. Then there is a co-location. I'll discuss about the co-locations. Then internet-based trading, mobile trading, smart order routing. Although smart order routing has been stopped. If we see the trend, the non-algo trades is came down, and algo trades, although has not gone that much up, but internet-based trading and mobile-based trading has gone up. Okay. So in terms of mobile-based trading is mobile app, internet-based trading means we are trading through our system, or we are trading through our laptop, either computer or laptop. So then mobile-based trading is also getting increased. Now, what is this co-location? Now, the co-location, if we understand, like, so how much time I have, Dibyendu sir?
Sir, 30 minutes, 35
Okay.
minutes.
Thank you. Okay, so co-location is like I need to co-locate my trading terminal to the exchange trading terminal. For example, if exchange trading terminal is in BKC, which is Bandra Kurla complex in Mumbai, and my terminal is in Bangalore or in Bhubaneswar, I'm a broker firm, and one broker firm whose trading terminal is in Bombay. So whose trading terminal is in Bombay. So he is very close to exchange, although it is fraction of seconds. His order will get traded fast as compared to Bangalore or Bhubaneswar or in that term Delhi. So his trade will get fast executed. What exchange is offered? Exchange is offered one thing, that you can relocate. Relocation means you can relocate your trading terminal to exchange trading terminal. So you bring your trading terminal and keep it inside exchange trading terminal. So if this is exchange server, you say this is exchange, you can keep close to the server. So broker 1, broker 2, broker 3, broker 4, broker 5, like this you can keep, and you need to pay, broker need to pay a certain amount of fees, which is called as co-location fees, to opt for this service. When broker pays, or broker will pay, now broker needs faster trade or faster execution. Now the broker who is there inside the trading exchange trading terminal, this broker, if you say this is second broker, this is first broker, this is third broker, this broker is very close and this broker is little far from the exchange trading terminal again. And everybody are paying the same co-location fee. If everybody pays same co-location fee, they should get same speed of execution. Now what exchange has done, exchange has measured the length of wire that is required from the distance broker's trading terminal which is there in that co-location, and exchange has given the same length of wire to everybody. So he will keep like this, or it will keep like this. That means everybody will have same execution time, so that no one will get very superior facility or inferior facility. So that is what co-location is. One is co-location helps more liquidity because frequent trading will happen and very speed of trading will happen. And co-location helps in price discovery. Although there were certain shortcomings on that co-location, that got resolved again. So that means co-location helps in growing the market activities. Okay. So then if we come to derivatives market, there are many derivative products that are there. So I leave with maybe 15 minutes or 10 minutes for all of you to interact. So after 10-15 minutes, I'll stop. So we are number one across the world in terms of derivative products, and we are number one. So if we see the history of Indian derivatives, we started with equity derivatives in 2000. Then we moved to, we introduced commodity derivatives in 2003, currency derivatives in 2008, and interest rate derivatives, although we introduced in 2003-04 and reintroduced in 2009 and reintroduced in 2012, it was getting failed, but 2014 again it got reintroduced and it is getting traded. Now, who are the regulator of these products? If you see equity and commodity, SEBI is the regulator. Currency and interest rate, SEBI is regulator of the derivative product, but the underlying, which is currency spot and interest rate spot, the regulator is RBI. So again, to design this currency derivative or interest rate derivative, both SEBI and RBI sit together. Now, the same activities that happens in the derivative in terms of mode of trading, if we observe like non-algo trades has came down and co-location trades has gone up, you see almost 50% of trades are happening through co-location. And internet-based trading, although is happening, but mobile-based trading has gone up in derivative market. If you see mobile-based trading in terms of equity cash market has not gone that off as compared to the derivatives trading through mobile app. Now, there are stock and stock-based derivatives and index-based derivatives. In terms of index, there are two products. One is option and another is future. If we observe the trading activities or the turnover in index derivatives, which is index option and index future, so negligible amount of index futures are getting traded and almost 100% of index options are getting traded. That means option, I told you in the beginning, like option is the most beautiful instrument in the securities market. Out of 4 derivatives, if we put together currency, commodity, equity, and interest rate, almost 98% derivative transactions are equity transaction. If we put together 100% transaction of all the derivative products, 97% or 97.5% are from equity, and the Second highest is currency, then commodity and interest rate derivatives. So equity derivative has gained the momentum, and this commodity derivative has the participation or the contribution has come down. There are certain issues in currency derivatives, sorry, commodity derivatives. This we discussed. Now, although this is little old, but there was a study by SEBI, like the analysis of profit and loss of individual traders in equity F&O segment. You see, so individual traders in the F&O segment, 45 lakh in 2020 and 7.1 lakh in financial year 19. That is gone up by 5%, 500% is the participation, and they were dominated by males. So 80% are male, and 89% were like 9 out of 10 are losing in the market. And in 2022, again 11% were making profit. That means 91% are losing in the market, and the average profit was 1.5 lakh. So in option, 98% individual traders trade in option, and 11% trade in future. Like over and above the net trading loss incurred or loss makers expand an additional of 28% of net trading losses is transaction cost. Our transaction cost, like I listed out, SEBI charges, exchange charges, clearing corporation charges, broker charges. So individual traders were losing because they were paying too much of transaction cost or transaction charges. Now, recently, if you see, SEBI has changed this position limit. What is this position limit? This position limit led to ban of stocks from the F&O market or futures and options market. Now, how does this position limit work? In each of the newspaper, you will see this stock got banned from the market, that stock got banned from the F&O segment. So this ban is not banned forever. This ban is for a certain period of time. Let us understand what this ban is. So this position limit is one type of restrictive regulatory measures. Since derivative settlement happens on physical, all the equity derivatives or stock derivatives settlement happens physically, compulsory physical, and index derivatives settlement happens compulsory case. Since it is stock derivatives are mandatorily settled physically, that means that much shares has to be delivered. So we limit the speculation. Okay, so we want hazards to come in more, and we limit the speculation. That's why we implement one regulation or one criteria, which is called as market-wide position limit. And if that market-wide position limit is reached, or in any time it is reached, then that stock will be banned from that F&O for a certain period of time. And if a transaction of futures and options reached 20% of market-wide position limit, will get banned, and now it has been reduced to 15%. So let us take one example to understand. If free float market capitalization is 100, then market-wide position limit will be 20% of free float market capitalization, which is 20. Now this becomes 15. So then if 95% of market-wide position limit we reached, then that means if it is reached 90, then it will get the open interest reached 19, then the particular stock will get banned from the F&O segment. Okay, and once banned from F&O segment means new transactions or new positions cannot be created. Only the existing position can be squared out. Like if I have taken one buy position or sell position, I can square up that, but I cannot take a fresh position. If that 19 comes down to 16, okay, which is 80% of MWPL, so then it will be resumed to trading or that ban will be lifted. So that is the whole process of position limit. Now that position limit is there to control the activities in the derivatives market. Now, in terms of if you see single stock futures, NSE is top 4, and in terms of single stock options, NSE is coming under top 10. But in terms of single stock index option, NSE is number 1 across the world. And in terms of stock index future, again NSE is coming on top 10. So if we see in terms of currency, again NSE is number 1 both in currency future and currency options. Interest rate future, although there is a lot to do because interest rate future is picking up, but still we are number in number 10 in terms of interest rate options. So there are certain developments in terms of commodity to increase the commodity participation. Earlier, institutional investors were restricted to participate in the commodity market. So when FMC got merged with SEBI in 2015, afterwards commodity or the regulator, which is SEBI, allowed the phase-wise allowed the categories of institutional investors to participate in the commodity market. So first one you see, AIFs were allowed in 2017. Then mutual funds in 2019, PMS in 2020, and FPIs in 2022. We are just analyzing before 2-3 days. Now FPIs are contributing 4% transaction in commodity derivatives. Now, since it is just 2-3 years of permission that we gave, maybe going forward they will increase their participation, and institutional investor may help in developing this or may help in increasing the open interest or increasing the turnover in the commodity market. Now there are instruments like green bond, differential voting rights, or zero coupon, zero principal instruments, REITs, InvITs, or municipal bonds, or IRFs. So this green bond is again one innovative instrument which is issued to carry forward the green activities. There are green activities are defined. So those these are innovative instruments developed by World Bank with the request of some institutional investors. And SEBI brought out the regulation in 2017. If you see, there are process of issuing the green bond. I'm not going to that process, but I'll just tell one way, which is this green bond is 2 other colors. Okay, one is your yellow bond and another is blue bond. So this blue bond is for ocean environment or the taking care about the quality of ocean waters. Yellow bond is for the greenery or yellow projects which will enhance in terms of safeguarding our forest or safeguarding our climate in terms of permitting to certain amount of factories or giving some amount of refinery system to reduce the carbon emissions. So all those are coming under yellow bond. So they are the subcategory of green bonds. Now differential voting rights is another instrument which is not picking up in India. Even Tata Motor has bought back the differential voting rights shares and converted into ordinary shares. Zero coupon, zero principal we have already discussed, and REITs, InvITs also we have discussed. Now let us see, municipal bond has been picking up like good. It started in 2017 with Pune Municipal Corporations. Now almost 8 to 10 municipal corporations is issued. Now in terms of sustainable finance, we discussed about like green bond, yellow bond, and blue bond. There are other bonds like social bonds for the social organizations or social enterprises. Then sustainable bond with which are satisfying the sustainable criteria, and then sustainable linked bond. So sustainable linked bond is issued by the companies which cannot stop the emissions but can act or can implement some techniques to reduce that emissions or to take care about those emissions. Suppose, for example, one chemical company or one say tobacco company. So they create more say emissions. So for them only, so sustainable linked bonds are applicable. So we brought out regulations like BRR, which is business responsibility reports. Then we moved to BRR-SR, business responsibility and sustainability report. Then again we moved to BRR-SR core to mandate the companies. So initially it was implemented on phased manner on a optional basis. Thereafter it got mandated to companies to bring out what are the sustainable activities they are doing. So that was part of BRSR, and we brought out the ESG framework also. Now let us understand some of the regulatory innovations. One is interoperability. So interoperability is like connecting the each of these clearing corporation into one umbrella. That means earlier when I was buying from BSE, I have to sell at BSE, but now I can buy from BSE and sell at NSE because of this interoperability. That means BSE Clearing Corporation and NSE Clearing Corporation, they are coming under this interoperability mechanism. So I can buy from NSE, sell at BSE, or buy from BSE, sell at NSE. So that is very good development, and online KYC post-COVID has helped us to increase the number of participation of individual investors, and ease of capital raising also helped many companies to raise funds. Even we are just bringing down the listing days from T+6 to T+3, and we are also bringing down the ticket size of bonds from 1 lakh rupees to 10,000 rupees. Then the margin obligations are now from the client point of view. And SEBI also introduced securities market trainers who are training for the financial literacy across the world. Although ELSS, which is equity, which is a tax saving scheme, was there in the active fund. So SEBI allowed in the passive fund, but since all of you are aware, we are moving to new tax regime and many are opting for new tax regime. So this ELSS instrument may not be there after some years. But yes, passive ELSS got introduced, and SEBI scores is there for filing complaint by anyone whosoever are coming into any of the fraudulent activities anyone is doing, any market intermediaries is doing, we can file on the SEBI score. So weekly expiry, since the participation is more in derivatives, that two index derivatives, the expiry date of stock derivative is last Thursday. Now, but all the index derivatives expiry date was each Thursday. That means weekly expiry. Now, SEBI brought out a regulation that one exchange can have one weekly expiry index. If NSE was having 4 equity derivatives, index derivatives, NSE has to keep all equity index derivatives expiry at the end of the month, but weekly expiry, only one instrument can be there. So then that has also resulted to control this derivative transactions. There is a very recent development which is called as forward. That means, you just verify the risk and return metrics through past risk return verification agency, which has been recently created. Now, stockbrokers has been now allowed to operate from the GIFT IFSC through special business unit without SEBI approval. Then MWPL revision that we discussed, and we have introduced one very good thing like 250 rupees SIP. If you see systematic investment plan as 500 or 1,000 rupees, depending on the funds. Now, one chota SIP, it is called as like 250 rupees SIP one can do. So this interoperability is like this. So this was pre-interoperability. Exchange A was somewhere, exchange B was somewhere. Now, if you see in the interoperability, everyone is connected so that one can buy from one exchange and sell in another exchange. Now, there are specific benefits like when market is growing that much, we crossed market capitalization crossed 5 trillion, and we are growing in all the asset classes. Market intermediaries are also has gone up. Even participation in terms of institutional investors or individual investors are going up. Again, the new innovative instruments that are coming into market and helping the companies to raise funds. Then there are a certain role of CMAs as a strategic advisor for cost efficient capital raising and financial analyst expertise on the IPO pricing, ETF structure, buyback and share buyback, and technology and risk management. So there were so many financial frauds that are happening. So the real-time financial reporting and robust risk management adoption. And although governance and audit readiness is the key factor of a CMA, and many companies which are admitted for the insolvency, they just earlier manipulated their EBITDA or their balance sheet, and they have shown something. Then when really that come up, and they are admitted for the bankruptcy or they filed for the bankruptcy. So with this, I will just stop here and we can take question answers. And thank you for patience listening for a long period of time. So yes, I am open for question answers.
Yes, sir. So one part, sir, we request the CMA. CMA, what can they do in the various innovative schemes which the government has introduced in the capital markets by strengthening governance and investor confidence?
Yeah. So just like at last I told, in each of the developments or whatever market say regulation got revised, each of these CMA's role are more. For example, if we go for social audit, for example, more and more companies are bringing out IPOs, they need the auditors, and for governance issues or sustainability issues, or simply advising them which is the cost effective way for financing. So all those the role of CMAs are highly required. Like CMAs are most important, you say, professional which are required.
Right, sir. Sir, in your presentation you covered, but still, sir, one question has come in the chat box, like cyber security threats and systemic shocks in this digital era. How the SEBI is taking care for protection of the investors?
Okay, so always cyber attacks are there. I'll just tell you one small things on this. So there are firewalls to protect all the cyber attacks. Even RBI also gets cyber attacks. SEBI also gets cyber attacks. Even from international cyber attacks, there are more. So firewall protects them. So so far, none of the cyber attacks is impacted our market. There is another very effective things that our market regulator has done is automatic. If anyone is doing cyber attack and doing some of the outlier trades, if everybody is buying, one is selling, or everybody is selling, one is buying. So they have done this automatic detection. Okay, there is a software to detect 500 outlier trades. For each of the scripts, 500 outlier trades will get detected. After that, it will be sent to say investigation department to see whether these outlier trades were like genuine trades, or there are some insider information, or there are certain market manipulations someone is trying to do. So those are getting detected, and if you see, in no point of time we have seen any of the cyber attack has impacted our market. But yes, cyber threats are there.
Right, sir. Sir, in your presentation, you have quoted SEBI's the statistics. 95% of the investors have lost in F&O market. So one of our participants has written that then why not banning them? Because retail is getting the impact of losing money, hard-earned money through these instruments.
Yeah, so that was also a debatable one, whether to totally ban the individual traders from the market or not. So there were some solutions that came out, SEBI already implemented. So first, increase the so SEBI has increased the lot size. Okay, now minimum lot has been increased. Second, increase the margin requirements, especially for short selling, or when we sell options or sell futures. So on the sell side, margin has been increased. Now we don't want chiller individuals or chiller traders to trade. Those who can take risk, they can. Then in every app or in all the broker apps, SEBI has given this disclaimer like 91% are losing in the market. If you are ready to take risk, then you enter. So now in front of me, all the options are available. No one is forcing me to participate, but if I satisfy these requirements, I will participate. Now, if we ban totally the individual traders, there are many individual traders who are skilled individual traders who does for the who participate for the hedging purpose, or they are skilled in terms of earning, or they are in the 9% or 10% of the profit side. So that will not be justice for a market to totally ban. So there are restrictions that are being implemented. Now, another restriction, that MWPL restriction also, these all developments that came in is after this SEBI report. Okay.
Right, sir. Sir, one question another comes into the mind, that in the primary markets also IPO listing gain, many of the speculative investors are making some gain. Why not some limit should be enhanced so that company cannot be sold, the persons, those who are getting the allotment, they cannot sell within a phase of time, so that listing gain doesn't occur and speculation doesn't creep up in the capital markets. What is your view, sir?
So the restriction is there for the anchor investors or the institutional investors, like they cannot sell within a month, like minimum holding period for them is 1 month. But that is not there for the retailers. So retailer can sell on the other day. One is it is not only the listing gain, giving opportunities to the subscriber who have not got the allotment. Like who have not got the allotment, they are waiting to buy from the secondary market. If we totally restrict only those who participated or got the allotment should hold till 1 month or 2 months, then liquidity will harm the liquidity in the market, price discovery will not happen, then it will lead to a stagnant market, which will not help or encourage anyone to come into the market. Now, in terms of either listing gain or listing loss or participation of the individual traders, SEBI may increase the lot size. So currently lot size is 15,000 rupees one lot in IPO, and that is main board IPO, and 1 lakh rupees in terms of SME IPOs. So SEBI may increase these limits, but yeah, we cannot harm the market's price discovery and liquidity.
Right, sir. Sir, another aspect is that we are seeing margin trading. For that, many of the investors, they are losing their hard-earned money. Maybe they are falling in that vicious circle. So, do you think that sort of investment criteria should be limited for retail investors?
Yeah, so that's why we disclose our annual income, and this margin trading facility is by default not allowed. Those who wish to opt for that margin trading, then we can opt and get the approval from the broker to get that margin trading facility. And through margin trading facility, we are paying. It is normally borrow and invest kind of thing. So we should avoid that. It is allowed for those who are again skilled and participating in the market, and they want to participate in a larger volume. But that margin is based on your holding. It is not unlimited margin that we get. So in the margin trading, it is based on our holding that we hold on our securities, broker allowed. Although this is not very good for the individuals who are falling into this trap and only participating on the margin trading, you are correct. It should have not been allowed to the certain individuals who are losing in the market or who are not able to, you say, generate income or get benefit out of that.
Right, sir. Sir, evening trading like Nasdaq and NYSE, they have started evening trading. Why not our exchanges?
So it is like apple and orange comparison. So they have also started one market called as cloud market. Yeah. So that cloud market is again a very big story that may come to India after 20 years or 25 years. See, USA is following a hybrid market, and they are not only order driven market. And if you see, whatever financial crisis that came into world has been generated from US. You see your 2008 financial crisis, you see any of the 1987 stock market crisis or Black Monday, everything has been generated from USA. So that does not mean whatever USA is implementing, we should also implement. It depends on the participants and the market demand. So that's how in the beginning I told you, the market structure for each of the countries are different. We may follow some of the markets which are similar to us. We cannot follow apple with orange or orange with apple.
Right, sir. I got your point, sir. Sir, another just last question, like mutual fund allotment, they are happening at T+0 days, but same thing is not happening in the stock. Sir, what is your thoughts?
Okay, so in terms of stock, I told you like T+0 we allowed in terms of optional. It's not mandatory. But when it is optional and no one is taking the interest, so who requires this T+0? Mostly the individual investors or small investors. In individual investors, HNIs are there and the retailers are there. Mostly the retailers. And in the retail category, those who are trading frequently. If an investor is there, will not require frequently to buy and sell or do the portfolio churning every day. So those are day traders. Again, on the day traders, those who don't have sufficient money, they want money, they can opt for T+0. So T+0, just like I told you, it has a trading cost. It cannot be implemented just like that. We call it as a regulatory cost of implementing a new regulation. So that regulatory cost to the market is huge in comparison with the benefit to the small retail traders. So that's how it is not open for all the script or all the stocks. It is open for limited script, and I'm sure SEBI will not implement this T+0. Although the previous chairperson was very keen on implementing, but still no one is. That's how they are just postponing the implementation. It may not happen.
Right, sir. Thank you, sir. I think we had a wonderful session today, and I thank from core of my heart, Dr. Pradeep Panda sir has taken the time off. I know sir is very busy, and we had to plan it. I think, and sir, we are thankful for your wonderful presentation. We'll upload this presentation in our YouTube channel for those members who could not attend today. And we also thank our chairman, CMA Chittaranjan Chattopadhyay sir, for always encouraging us to organize more webinars in this online forum, and also our advisor, CMA Partha Choudhury, who is also a part of our team. And we also thank our president, vice president, our other council members, our BFSI board members for their continuous encouragement to organize more online and offline sessions. We also thank our team members, those who are from the back end, they have supported for this fruitful association and occurring of this event. We also thank our other departments, CPT, IT department, for being an enabler to our event. And we are having another webinar on 11th of September on cyber security of the recent circular released by SEBI. And we request everybody to attend that. We will be having a wonderful session that. And with this, we conclude today's webinar, and we thank everybody for their participation. Thank you all.
Thank you, sir. Thank you, sir. There is a common question I can say everybody are asking for PPT presentation. I'll share with you.
Yes, definitely.
Okay. Thank you, sir. Namaste.
Thank you.